Good day to all of my fellow investors. Today I brought to you a new content type, which will be basically an earnings recap of the last week. I decided to go on with three companies: PayPal, McDonald's, and Starbucks. In this video, I will give you a quick overview of their recent earnings report. I hope you will enjoy the content. So let's start with the payment processor giant PayPal. The company reported earnings Wednesday this week. Since the report, the company's share price is up almost 9%. So, in general, the market really liked what is in the earnings report. Let's look a bit on Twitter what people are saying about PayPal earnings results. So, here is a short summary from Brad Freeman, and this summary really sums up everything important about PayPal's earnings. Uh, the company beat on almost all of the metrics compared to the estimates. Beat on revenue by 0.5%, not a lot, but still beat on EBIT estimate by 1.7%. The company beat on uh, earnings per share, both on GAAP and non-GAAP. However, they missed on the next quarter's revenue estimate by 1.4%. But all in all, general, the PayPal slightly raised annual GAAP and non-GAAP earnings per share guidance. Total payment volume since last year increased 15%, which is a pretty nice growth. However, the revenue just increased by 8.3%, and actually the active account number is decreased by 1% since uh, last year. The good news is the company is aggressively buying back shares. In this year, the total share repurchase is expected to reach 5 billion US dollar. That $5 billion amount represents around 8% of the current market capitalization of PayPal, which is a really, really big and impressive buyback yield. However, of course, the management is not highlighting it that they are spending a lot of money on stock-based compensation, which devalues the buybacks, which acts as a negative on the other way. And for example, in the last 9 months, they spent around $1 billion on stock-based compensation, uh, which is for a company it's a non-cash flow or non-cash movement. However, it's still diluting the shareholders, and in my opinion, it really matters. So basically, that $5 billion we need to deduct from that around $1.3 billion, which already decreased that buyback amount to like 6%, which which is still really great, but much less than the original one. However, I need to add the credit to the management that they are doing the buybacks at least on time when the stock looks cheap. So they went really strong in buybacks in 2022 and 2023, and not strong in 2020 and 2021 where their share price was significantly overvalued. So So in this top area, when the share price was really expensive, they didn't really buy back almost any shares or just very small amount. So that is positive from the capital allocation standpoint. The company now guiding GAAP earnings per share for this year to be at $3.75 compared to 2.09 in financial year 2022, and non-GAAP earnings per share is expected to grow 21% to almost $5 compared to $4.13 in the last year. So there is some pretty nice growth, and the company looks reasonably priced currently. Maybe some people can even say cheap. Currently, it valued around 12 times non-GAAP earnings based on the $60 market price. The thing which brings concerns to a lot of analysts is that the branded products of PayPal uh, is only growing 6%. The branded products mean like PayPal and some of the bigger names. So they have multiple different platforms, and they are growing only like 5 6% this year. And the unbranded processing, which is a much lower margin business, it's growing really fast at 32%, but again, it's a lower margin, and this brings up questions about future margins of the business. However, PayPal is PayPal. It has a strong brand. It's one of the world's most trusted brands. There are 430 million active consumer and merchant accounts, massive amount of transactions going through PayPal system. So they have a mode in that area. It's without any questions. The company is constantly innovating through different ways. It's about safetiness. As I said, it's one of the most trusted brand. They are bringing up some new innovation regarding that, and there are new ways uh, to gift with Venmo. Venmo is their other big product and platform next to PayPal. So yes, there are constantly innovations, and they try to maintain their market share and to retain their customers. They are launching a new dollar denominated stablecoin called PayPal USD. Honestly, I do not really like that idea. Basically, just a few months ago, it was a big stablecoin crash. There were multiple of those stablecoins crashed. You can see a lot of articles on the internet about it. I don't like so much that PayPal idea. However, if it goes well and they can make it really stable, then it can be a possible new revenue stream. All in all, pretty nice earnings from PayPal. Nothing wrong with it. However, let's move on now to the next stock. And yes, you are guessing it right. From the video, it's McDonald's. McDonald's will be the next one. McDonald's released its earnings on Monday. They were beating estimates by around 5% for the earnings. Instead of $3, they earned 3.17 dollars, and for the revenues, they were beating slightly also estimates. Instead of 6.55 billion US dollar, they had 6.69 billion dollar in revenues. The market didn't react a lot to the earnings. The share price barely changed in the past 5 days. I would say it's mostly about it's changed because of the rally in the last few days on the stock market. It just up 3% in the past 5 days. Nothing special happened since the earnings. It's because probably the market thinks, even though they beat, the P ratio is already 24 almost. The dividend yield is not so high, 2.5%. The market needs more than that for a big rally for McDonald's, as it seems, in the current market environment. So let's check a bit the earnings report. McDonald's increased 11% the revenue since the last year, with global comparable sales of nearly 9%. which is a strong, and inflation again as for PayPal, it's really helping for McDonald's also. And for McDonald's, it's a capital light business. It's mostly franchising, so it means that they receive a lot higher revenue, and almost like because of that higher revenue, not only the top line grows by that margin, but it flows into the bottom line. So like a higher inflation environment, it's really great for McDonald's. And also macroeconomic instability, and when people have less amount of money, it's nice for McDonald's because they are cheap, or like they are giving value to the customers. As they also say that the macroeconomic environment is unfolding in line with their expectations for the year, and they continue to deliver convenience and value for the customers. So the diluted earnings per share was $3.17. This is an increase of massive 18% and 15% in constant currencies. And another good news is that the company declared a 10% increase in its quarterly cash dividend. This will increase to 1.67 per share, which means actually around 50% payout ratio if we calculate the earnings per share and the cash dividend. And again, let's look a bit at Twitter. I found a really interesting chart from Cannibals Invest. You can see here how consistent McDonald's is in the past almost 15 years since 2009. The revenue per share doubled, almost doubled in that 15 years, but the earnings per share uh, tripled basically in a quarter, as you can see, from $1 to $3. So yes, McDonald's is pricey. However, with McDonald's, you are buying stability and constant dividend increase. And finally, let's move on to everyone's favorite coffee brand, Starbucks. It seems that the pumpkin spice lattes are going really well this year, as Starbucks beat estimates for the current quarter. They beat estimates on revenue, on adjusted EPS, on same store sales, and on same store sales in China. The only thing which they were under the estimates is the traffic growth, same store sales. Starbucks released their numbers on 1st of November, and immediately the stock jumped 10% based on these numbers. They were really good. The market also liked it. And since that, the stock still moved a bit higher, but not that much. On a yearly basis, the stock is up around 14%. And in the last 5 years, with big ups and downs, but still up 62%. Compared to last year, Starbucks had 3% margin expansion. Now the non-GAAP global operating margin is 18.2%, 31% year-over-year growth in non-GAAP EPS to be around $1, and the global store count also grew by 7%. So Starbucks is still a growing company. It's still mostly based in the US, 74% of the revenue coming from the US, 21% international. Comparable sales growth is 8% globally, 8% in the US, and a little bit lower, 5% in China. Starbucks is going digital. They have 33 million active members in the US and 21 million in China. They had a very successful fall launch, six highest sales weeks ever. And for the full year, mostly the same numbers are true as comparable sales. The non-GAAP operating margin for the full year is a bit lower, not 18 but 16%, and the total year EPS is 3.5%, but this is a 20% increase compared to financial year 2022. They also provided guidance for financial year 2024. Uh, they are expecting a bit lower, but still 5-6% comparable growth in all of the regions, globally, US and China, and they are expecting 7% global new store growth, the most in China. You need to keep in mind, if you are investing in Starbucks, you are investing a lot in China also, because this is their growth area mainly. China, they want to build a strong position in China, and it's becoming an even bigger part every year of their business, the China revenue and profits. Because of the comparable sales growth and new store growth, they are expecting around 10-12% growth. They say that they are expecting 15-20% earnings growth for 2024. This would mean that this year they had $3.5, so they should be around 4.1, 4.2 dollar in the next year. So that's it for now. I hope you like this short video format. Maybe another time I will do a more deep dive about these companies, but this is the end for now. Have a nice day.